All right, guys, this is Ryan Brown on Beechmont Breakdown. We are decoding real estate investing, and today I have an awesome guest, Yonah Weiss, the cost segregation king with Madison Specs. And Yonah, welcome. Thank you very much for joining me today. Why don't you give us a little bit of your background and how you kind of found your specialty here, your niche?
Sure, Ryan. Appreciate you having me on the show. It's great to be here. Background is in teaching, actually. I was a teacher for about 15 years before I found real estate, or it found me rather. And was dabbling for a couple of years, doing a bunch of random different things, just kind of getting my feet wet and learning everything there was to know about real estate, including mortgage brokering, hard money loans, fix and flips. Did some residential brokering, trying to find some land deals, literally a lot of different things all over the place, until I was introduced to this company, Madison Specs, Madison Commercial Real Estate, that I'm currently working for almost 6 years ago. And they are the biggest national cost segregation company. I didn't know almost, what that was at all at the time, which to me was, now looking back is not so surprising, because the more people I talk to, the more I realize nobody really knows what this is. And so I've been just trying to change that for the past 5-6 years or so, just trying to educate the masses and teach people about what cost segregation is. In the interim, through that process, it's been an awesome opportunity to connect with and network with some of the most incredible people in the real estate industry across every asset class in every market. And through that, I've done a lot of investing, both on the passive and active side as well. So it's really opened me up to a lot of opportunities.
Well, so just jumping right in then, and you hit on it too. It's like a lot of people don't actually know what cost segregation is. So just at the very bare bones, we're breaking up so that we can depreciate things faster. How exactly does that break down? And what types of things can we depreciate faster? And what's the advantage of that?
Absolutely. So anytime you own a business or rental property, you get this deduction called depreciation. And so for listeners, if you're not familiar with that, it just essentially means that the IRS allows you to deduct from your income tax the entire amount of the property, the purchase of your property, over a long period of time. Okay, 27 and a half years for residential or multifamily, or 39 years for other commercial properties. What cost segregation does is it breaks down that property into different categories or different components. And some of those components can depreciate or can be taken the tax deduction of those components at a faster rate. So for example, anything that is non-structural in the property, like furniture, fixtures, equipment, appliances, window treatments, cabinets, flooring, all kinds of things that are not integral to the structure, all those things depreciate on a 5-year schedule instead of that long 27 or 39 year. So the advantage of taking the deduction of those values at a faster rate is increasing your cash flow in the earlier years of ownership. Essentially, it's a time value of money play, and it allows you as the investor to essentially not pay any taxes on your income during the hold period of that property. And in fact, there's even more advantageous for someone who's a real estate professional, being able to use those deductions not only against your passive rental income, but also potentially against other income as well.
And so on the surface there, it seems like a no-brainer, and it seems like, why doesn't everyone know about this? And I think about probably, and I came from, single family investing.
Mm-hmm.
Is there a minimum threshold to where this is really advantageous? What amount, in percentages could I expect from like a single family home versus, multifamily buildings or anything like that?
For, every property is unique, but there are certainly averages. For a single family property, you're looking at, easily about 15 to 20% of that purchase price that you can accelerate the depreciation of. Certain types of properties, you can get up to 25, 30%. And then, there are even others like mobile home parks or RV parks where you can literally get up to, 60, 70, 80%. In fact, this week, I actually finished a study on an RV park that got over 94% of the purchase price going towards accelerated bonus depreciation. So, but that's not your typical type of property, but your average type of property is, 15 to 20%. So if you factor that in with the cost of getting something like this done, which is typically a few $1,000s minimum, the advantage really starts to become, over a $200,000 purchase price. And then, upwards of that, the greater the value, the more proportional the benefits are. Because essentially the cost of getting a study done is pretty much going to be the same, regardless if it's a small multifamily, for example, like a 5-plex or a 4-plex, or whatever, or a 100-unit building. The cost to get it done is essentially going to be the same, but the benefit that is exponential, because again, it's totally dependent on that purchase price.
So so that leads me to two questions. First, though, I've got to go back to the RV park.
Okay.
So how are we getting all of this depreciable value out of the RV park when people own their own RVs? And so essentially I just had to, and I'm very interested in this because I'm currently about to build an RV park.
Awesome.
And I've been thinking that I'm not going to have any depreciation because all of my cost is really in the land. And so I'm pretty interested here.
Absolutely.
Where do we get our depreciation in an RV park?
So the main depreciation comes from what's called land improvements. So not land, because land, as you alluded to, doesn't depreciate. And so you're always going to have to subtract land. If you buy an existing property, you always have to subtract the land value, and then the rest is going to be depreciated. But if you're building something, construction, the land cost is non-depreciable. It's only the improvement costs. Now, if you buy an existing park, there are a lot of land, what the IRS defines as land improvements, that depreciate on a 15-year schedule and are eligible for that first-year bonus depreciation. Examples of that is like pavement, concrete, even if it's like brick pavement or asphalt, it doesn't matter. Landscaping, fencing. And so when you're looking at an RV park, like you mentioned, the owners really own the RVs. What do you, as the owner of the property, own? Maybe there's a clubhouse or something like that, maybe a laundry room or something, some electrical hookups. But essentially, the majority of everything that's there is in that land improvements, the pavement, the concrete. And so as long as it's not like dirt roads, you can get a huge amount of depreciation in that RV park.
That's very interesting to know. So it's unfortunately I've got an excellent location, and so the bulk of mine is actually the cost of the land.
Yeah.
But we are going to have to still do some improvements, so I guess we can get some depreciation. And so like where I was thinking, other than the RV park, is what are some potential downsides of accelerating and taking all this depreciation up front, can you think of any downsides?
Absolutely. Just like you said, taking more depreciation up front simply means that you're going to have less depreciation later on. Meaning, instead of splitting it up equally over a 27 or 39-year period, you can front load that 20, 30% or so into the first few years. That means after that point, if you hold the property for that long, you will have relatively less depreciation going forward. And it doesn't mean you're taking all the depreciation up front, except for that, example of the RV park, but it does mean you're taking a portion. And so it will be proportionally less depreciation going forward. Now, is that a downside per se? If you are a one property person, then potentially yes. If you are a real estate investor and the goal is to continue buying properties, continuing to scale, this is a great tool to continue to do that. You can use depreciation from one property to offset the income or the gains from another property. So all rental properties are lumped together in one bucket for that purposes. And so it doesn't mean that you're necessarily going to be hit hard because you have less depreciation deductions, as long as you continue to invest and continue to buy property. I would say that there is one other really big potential downside, which is what people call depreciation recapture. And this is a tax. There's a lot of misunderstanding around this. And it's important to understand it, because people think it means depreciation recapture. People think means I have to pay back the depreciation I took. And that's simply wrong. It does not mean that. It means you are subject to a tax as a gain, like a capital gain, just like when you sell a property, if you made a profit, you're going to be taxed on that amount of the gain. So too, the amount of depreciation that you took is considered an unrealized gain, and therefore you're taxed on that amount. And that's not so simple. Number one, doesn't mean you have to pay it, because there are strategies to defer or to deduct that tax. And similarly, it doesn't mean that you're paying it in full, because again, like I said, there's a 25% maximum limit on a certain type of that recapture. There's other parts that are taxed at an ordinary income rate, but essentially in the game of real estate, to continue buying properties can actually help you in the long run.
Yeah. So essentially, it's not necessarily a downside at all. It's just something that you need to have a strategy for. If you intend on, you had mentioned if it's a 5-year hold period. Well, at the end of that 5-year hold period, if I intend to dispose of the property, I need to have a plan. If I've loaded all three or $400,000 depreciation up front, I need to have a plan for how I'm going to reinvest and kind of keep moving forward. Which, you know, this essentially, and like what you said earlier, it's a time value of money play. If I can keep my money and I can reinvest it right now, it's going to be worth a lot more
Right.
than the money that I get down the road. So excellent. I've got another question that just kind of popped up in my head, and we didn't discuss this before the shows here. So, what happens to my depreciation if I'm investing like within an IRA?
So that's an excellent question. Many types of retirement accounts are considered tax shelters, in which case you cannot benefit from depreciation. And so if you're investing through a Roth IRA or through a self-directed 401k, those are, like I said, tax shelters. You're not going to get any benefit from the depreciation. So number one, you cannot invest your retirement account into your own property. Okay, it has to be invested in someone else's deal or syndication or something like that. However, just make sure find out from the sponsor, whoever you are investing with, whether or not they're even planning on doing a cost segregation study, because essentially it's not going to benefit you as the investor if you are investing through a retirement account in most cases.
Awesome. Yeah, and so that's just kind of really interesting consideration, because then as I think about this, your heavy opportunities for depreciation are probably the best places to put your cash. And then if you've got heavy cash flow deals with not a ton of depreciation, then that's probably where you want to be in with your IRAs and things like that. So,
yeah, exactly. The investment strategy should definitely take into account those factors.
awesome. And so you mentioned briefly, and I kind of want to touch on this because I kind of want to talk about how we can group these things together. So the real estate professional status, and this has been, the real estate professional status was my intro to cost segregation at all, because I come from a single family homes, real estate agent background. And eventually I started to get some clients that made a lot of money and they were trying to find a way to not pay so many taxes. And they found some other tax people. And then I stumbled on this real estate professional aspect. So can you just kind of briefly discuss what that is and kind of how people qualify for that and why they would want to?
Absolutely. So simply put, first we'll honor the real estate professional status, and then we'll talk about depreciation and how the two work together in tandem. So the real estate professional status is an IRS's designation of someone who is full-time in the real estate trader business, materially participating in rental properties, essentially. So if you're a broker, you automatically qualify as a real estate professional. However, you still need to materially participate in some rental properties that you own, okay? Which means it's a minimum of 750 hours a year for either you or your spouse. Only one of you needs to qualify for this in order to get this status. Now, what does this status mean, and how does it help? And this is where depreciation comes in. Depreciation, or rather, let's start with rental property income. Rental income is considered by the IRS passive income. Now, if you ask anyone who's in the real estate, they will not tell you that it is passive at all. But this is just a classification. I don't know why they call it that, but it is a class on its own. Okay, there are a couple other small things that you may not even think of that are also considered passive income. But what you may consider passive, like stocks or crypto or anything like that, that's not passive from the IRS's eyes. That's considered portfolio income and treated differently. Now, the reason why this is important is because depreciation and cost segregation, which is just, again, an advanced form of depreciation, can only be used to offset or to reduce your taxable income from that category of rental income. Okay, so if you have rental properties and you're getting income from it, you can use the depreciation to offset that or to reduce that taxable income. However, it cannot be used to offset active. If you have a W-2 or your spouse is on a W-2 or you have portfolio income, etc., you cannot use the depreciation to offset that. Unless, and there are a couple exceptions, and the biggest one is the real estate professional status. If you have this real estate professional status, you no longer have that limitation. You can use these extra deductions to offset any active income. And so this is where it's really important for someone who has, is doing fix and flips, someone who's doing wholesaling, is involved or as a real estate broker and making lots of commissions, you're getting taxed at a very high rate, the highest rate possible in most cases, and you don't have any deductions really to help shelter that. That's where rental properties come into play in doing cost segregation, to use that depreciation to then be able to offset that active income. And so that's why it's so special.
And so those are different timelines that you need to follow about how much time per year that you're putting into this. Go ahead.
And it is looked at on a year-by-year basis. So that's something important to note as well.
And what I have seen too is that a lot of time, and you mentioned this, is it's the spouse, because often if you have a very high income W-2 earner, husband or wife, well, then perhaps it's going to be nearly impossible, or probably impossible, to convince the IRS that that person is also spending their 750 hours working in the real estate business. But if you've got a spouse that does not have a W-2, well, a lot of times that's who we qualify. And then we're able to use all that depreciation to offset the other spouse's very high W-2 income. And then that is just another, like we had said earlier, it's a time value of money play, because now instead of paying, $250,000 in taxes, we just get to reinvest that $250,000 in taxes. And then, when they get the money back in the return the next year, just do it again. And then they get the return back the next year, and we do it again. And so it's a beautiful play. And I'll tell you the reason I reached out to you is so I have some clients that have been making this play, and it's been great for me to learn about the entire process. But now these clients are, they're thinking, well, I own millions of dollars of real estate in Louisville, Kentucky with Ryan. But, people get to a certain level of wealth, and then their, advisors are saying, well, you own a lot in Louisville. Why aren't you in other asset classes, or why aren't you in other markets? You just kind of diversify and spread your risk. So within this real estate professional status, you have to actively manage, but then that could be really difficult to be able to expand to other asset classes or other markets, because you might not have the team on the ground to be able to, actively participate. And so is there a way that you could be grouping your investments that some are passive within syndications and some you own in different entities that you manage yourself? How would all of that work?
Yeah, that's a great question. And there is an ability, there is a way to do that, and it's not automatic, and that's a really important point. So it's something that you need to actively basically aggregate all of your investments. There's something called a Group 9 election on your taxes, which allows you to group all of your rental properties together as if it's one. In which case, you don't need to spend the 750 or the 500 hours at different levels there on each individual property. You can just spend that 750 hours a year on all your properties, overall, and grouping them all together now allows you, even if you're not active, as long as you're active on some, right, and spending those material participation hours on some, then you can group together even those passive investments. So that's something really important, especially if you are, just thinking, oh, I'm just going to do everything passively. You may not be able to claim that real estate professional status if everything is totally passive at that point.
Is there a threshold as to how big you get? Because it seems to me like it would be a little kind of intuitive that at a certain level, it's not realistic that you have your hands in every single thing that happens with every property. When I have 10 units, I could probably obviously manage that stuff myself, and it's easy to make that real estate professional designation. If I have, 500 or 1,000 units, well, obviously I'm going to be paying some property managers, but I'm still involved. It's just that, my job is different as more of an asset manager than a property manager. And so does the IRS, do they make some kind of delineation there when you're trying to qualify for a real estate professional status?
Yeah. So there are certain activities that will qualify as the real estate professional status, and there are others that will not. And so it's important to kind of point out what those activities are. If you are at least a minimum of 5% ownership of a company, or of a property, let's say, then you automatically qualify as a real estate professional in that property, meaning you are actively managing it. As long as you are spending time doing the management, it doesn't have to be property management. It could be dealing with, like you said, the asset management, that is also included in the running of a property or of a property business. Because really, when you get into larger multifamily properties, like you said, like a 3, 4, 500 unit building, you're not involved in the day to day, right? You have property managers, you have full-time staff on there. However, you still are involved in managing them, in running the books, in taking care of vendors, and managing the property as a whole. There's also hours that are included in running the construction management, dealing with the acquisitions itself, right? Dealing with anything that has to do with, like I said, the running of the management of that property.
That makes perfect sense. I think that kind of covers, what I was looking to talk about today. I really appreciate your time. Do you have any kind of like parting shots, last things on the way out?
I would say, this is really important. There's so many nuances to cost segregation, and, we barely scratched the surface today. The most important thing I would say, if you are looking to get something like this done, speak to your accountant and make sure that this is something that they are comfortable with, and they understand. Unfortunately, it's not a given that accountants do understand this. So if you do own real estate or you own the real estate business, it might be worthwhile finding a real estate focused CPA. I'm not one. Our company focuses solely on the cost segregation, so I'm not trying to plug anyone here, but I come across this every single day, literally, with clients. So it's something that's really important. Just have that conversation, make sure they're familiar with it. If they're not, it might be worthwhile making sure you're dealing with someone who is.
Outstanding. Yonah, thank you so much for your time. A lot of great stuff today in just about 20 minutes. So I really appreciate it, and look forward to talking to you again sometime.
Pleasure. Thanks so much, Ryan.
Thanks.